The topic we're going to kick off with, which we may never leave because it's quite a big topic, is debt. But the question at hand that I want to ask these guys is, will 2020 see a debt crisis?
I would say this sharp rise of debt is only the one coin of the side, and you have to elaborate what has been done with the money on the other hand of the balance sheet, and therefore it's worth to make a differentiation. Is it gross fixed investment? Is it investment in infrastructure? Is it investment in education, in foreign direct investments? I think that's fine. Yeah? That will pay off, that will create value again. But if it is only for share buybacks, if you have special dividends, and when I see that Apple has raised debt about 360 billion US dollar only for share buybacks, I would say that is only a result of the zero or negative interest rate environment, and you have to reconsider what triggers such a huge debt increase, and that's absolutely a result of this central monetary policy.
Vincent, do you worry about this topic, or is it a non-issue for you?
No, I do worry, but if to answer your question, are we going to see a blow up this year? I would say no. Of course, it's always very hard to predict. But you can look at the level of the debt, which you do, but you can also look at the servicing of the debt. And with rates being so low, those ratios, service of the debt divided by GDP or divided by profits, those ratios are fairly low. What worries me is that with the monetary policy that we have today, you have a more hazard issue. And the governments don't do the hard work in terms of reforms that they have to do. Absolutely. You have those companies borrowing more money, and you have zombies company, effectively, which is bad for the economy. That's a misallocation of capital. That's bad for productivity.
Inflation. Yeah. We discounted it. We think it's not there. What if we're actually not measuring it properly? Maybe we've got the whole thing wrong. What is the argument to suggest that that might be the case?
There is a relatively small discussion, or a very poor discussion, about is inflation properly measured. And when we talk about inflation numbers, I would say there are some ingredients where we have to be cautious that the current numbers released are really accurate for the inflation development. A typical price pattern, when you have an introduction of a new good, new consumer good, industrial good, whatever is considered, it starts as a very high entry price. Yeah, because it's new, you have very low series produced, and then it starts to decrease in its price level because of demand side and productivity gains. So it's going down on its life cycle. And when it disappears and a new product is introduced, you have no price link to the old one. So you have this price gap not mentioned in the price index. That's a huge mistake.
But it's also possible that we are collectively blind, and that the market does not understand or has not figured that out. And in this case, clearly the big loser is the labor, the workers, because they, wages should follow inflation more closely, and they should be paid more.
And
and therefore that that would be a big scam. But let me say that this scam, if it is there, is about to get bigger, because the central banks this year, especially the Fed, is likely to announce a change in its inflation targets, and they want to make the inflation target more symmetrical. And that means they're going to work even harder in reaching that target, and that's going to be, I think, a dovish signal for the market.
Recently, inflation is strongly impacted, at least in Central and Eastern Europe, by increasing food prices. And food products is that what people buy on a daily basis or nearly the daily basis. They do not buy, I don't know, TV sets so often, so they do not feel if that such prices increases. If they feel that food prices increases, they think that this headline inflation, even if it is published, it was the latest figure in Poland, for example, is 3.4%, they think it's too low. And I think that this discussion of that it is measured in a proper way, I think it's sometimes impacted more by the perception that we have from households.
I think that there may be measurement issues, and that's I can buy it as a story. On the other side, I also repeat what Boris Vucic was saying in the previous panel. Do we really care on the exact figure or not? And does it really make an issue in terms of monetary policy? Are central bankers the only one that really look at the exact number and everybody else doesn't care? So for me, yes, there may be a measurement issue, but probably it's not so big, and probably it shouldn't be the only thing that we look at. Also because, and I link to the fiscal side, also because I think we all agree that the real problem is the structural potential growth of the economies we are talking about, and the fact that we are stuck since years in a situation in which potential growth is low and the structural issues are the one that we need to tackle.